Forbes India and Elever present a Quant Leap in Investing.
Hello and a very warm welcome to the special episode. Elever presents a Quant Leap in Investing in association with CNBC-TV18. I'm Mugdha Kalra. In today's fast-paced financial world, investors are demanding smarter, more personalized solutions to grow and protect their wealth. As technology transforms the wealth management landscape, the need for data-driven, customized strategies has never been greater. And one company leading this change is Elever, a platform that blends advanced quantitative research with tailored investment strategies to deliver smarter outcomes. Today, we are at Elever's office in Bengaluru to speak with the minds behind this innovation. Come, join me. Well, now I have with me Anshul Sharan and Karan Agrawal, co-founders Elever. Anshul is the Chief Executive Officer and Karan is the Chief Investment Officer. I do know there are two more co-founders. The fascinating story of any company is how do people come together and how do they have a shared vision? So Anshul, let me start with you. Tell me more about how did the story come together and what made you get into wealth management and how did your journey shape its vision?
So post, when I graduated from IIT Bombay and in my MBA from IIM Indore, I always had this belief that I need to give back to the society. And one of the core ways I could have done based on my pedigree and experience is by creating jobs. And the best way possible for me was to create, start my own startup. And so I did do a lot of things, like I, participated in a lot of competitions, one of them. I also had my own startup in the past, but I couldn't pursue it further because of I was doing the job. But come 2020, early 2020, when, I strongly felt that I need to start something, that's when, for two reasons, primarily because one is I was made some little money through the Trade Access Grameen's IPO. But more importantly, I felt I was around 37, 38 years that time. And I think if I delay it further, I think I will not be taking that much risk. Right? So that's the moment, I thought of starting Elever. Now, why, thought about investment space? I think there are two reasons for it. If I look at my personal experience, the way I have been investing since 2009, I think what I have seen is there's a clear lack of, availability of quality investment services for people in general, be it across the income stream, be it for people in the low income, there is nothing available. For the middle income, only if you invest some 25, 50 lakh, then you get a good service. If you are in the HNI segment also, if you are an emerging HNI segment, which has a net worth 2 to 5 crores, there also they don't get the right service from the PMS and AIF world. So that was one. Second is, if I look at my own professional experience, like I have worked in index capital in the past where I was building indices for global ETFs. So I learned from there, how rule-based, quant-based models can actually help you create sustainable alpha. And second, when I was part of Trade Access Grameen, I realized how lending can help improve the livelihood of the people. But if you can do it with investment, that's the best thing to happen because you become financially independent. So keeping both things in mind, and since in 2020, almost less than 5% of the India was investing compared to the global market, we saw a lot of untapped opportunity. And that's when we started Elever with the focus on investment space with the vision of investing for all.
This space is evolved and still evolving, if you know what I mean. And financial literacy has been such an important piece in the last few years. Even though the space has evolved, there are still a lot of challenges. Where did you find those gaps and what are you trying to solve?
So I think there are two critical gaps which we saw. The first one is lack of professional services. Okay. So let me quote some data over here. So if I look at India, as per December 2024, there are around close to 11 crore investors in the market. And if I look at number of investment advisors in India, it is sub 900. Let's assume 1,000. That means the ratio from investors to advisors is around 1 lakh plus, right? Even if I include in that PMS, AIFs, the top 1,000 MFDs, IFAs, then also that number is 3,000. So that average will come down to 40,000. Compare that with US. There are around 4 crore investors, and if you look at only investment advisors there are 17,500 of them. So the average comes to 2,200 compared to in India it's around 40,000, right? So there's a huge gap from that perspective.
True.
Even if I look at the HNI space, right, or even there also emerging HNIs don't get the exact service what a person who can invest 5 crores, 10 crores get. So that is there. Even for middle income people or middle to upper middle income, you get the service only invest 25 lakhs, 50 lakhs, then only you get the right service, right? So what we are doing as Elever, how we are addressing it is, through our advisory, we have, people can start investing at 50,000, 1 lakh
so
also.
Democratizing the process of growing your wealth.
Correct. So we have lowered down the accessibility from the amount perspective. Second, even for PMS, we are targeting only the emerging HNIs as our main focus, focusing on the tier 1, tier 2 towns. So that's how we are, addressing that gap. The second gap which we saw was lack of personalization or customization. Okay. Right now, if you look at all the products which are there in the market, like a mutual fund, stock advisory, PMS, EIFs, generally it is sold to a customer without understanding the customer. It's like a one
product being sold.
Okay. So what we are doing here is, for us, your personalization or customization, what you say, is our core approach on how we do things.
Karan, I want to get you in as a segue from what Anshul is saying. I do know personalization is a big piece that sets you apart, but the competition is intense in this industry, in the space where you're at. What are the things that are the differentiating factor then with Elever and others, and what is the strong point?
See, thing is, if you look at Indian wealth space, most of the products are following the old school technique of stock picking. Here you have a fund manager, and there's a team which is evaluating the company on the fundamentals, doing the research, and then they are taking a call on the stock and the sector. Okay, so the idea is to find a real value, a true value, and they compare it against the present value, and they accordingly, if they feel that there is sufficient alpha available. Alpha means basically what is the extra you are making over the benchmark. If a sufficient alpha is available, they take the position and go for it. So basically they are kind of exploiting the market anomalies which are there. Now the problem with these products, these old school products, is that there is a significant human bias. So if you are looking at same companies being looked by, let's say 10 managers, all of them come with the different outcomes. Some people will go overweight on the company, some people will go underweight. Okay. And the second problem, the biggest problem is, as markets are maturing, they are becoming more efficient, and these anomalies are disappearing. So, and this pattern has been repeated in developed markets like US and Europe. As you see, increased retail participation, higher analyst coverage, and thanks to technological progress, spike in computational power. Okay. So these opportunities are rare. Becoming rare. So learning from the US market and leveraging our expertise in factor alpha, okay, what we have done an extensive quantitative research covering 20 years, 5,000 securities across 500 parameters. And we have identified the parameters which are basically driving alpha in the Indian market. Okay. So they are basically explaining the alpha in the Indian market. And what we have done with that, we have built the individual factor models. Okay, based on this input, we have built the individual factor models. Okay, that has been tested again across 20 years. Okay, it's covering 3 bear markets: 2008, 13, 20, covering some bull markets. Okay, interest rate cycles, inflation cycles. Okay, geopolitical events that give us a rich data set. Okay, and based on this data set, we basically evaluate whether there is an alpha available, whether this alpha is substantial or not, and more importantly, how consistent and predictable it is. And at the last, can it be replicated for investors in next 10-15 years? So once we are satisfied on these parameters, we basically go live on these strategies. Okay, and go live means basically the security selection rules, weighing rules, rebalancing frequency, entire portfolio management. Okay, that would be done in line with the rules that were used in testing. Okay, so once the strategy is finalized, model is finalized, it will be managed in line with those rules. Okay, and manager would not have any interference in day-to-day portfolio management. So it's not like that I don't like a particular company or a Hindenburg report comes about Adani and I will interfere and remove the company. Okay, so it would be managed totally in line with the rules. Okay, so that basically remove the human bias that is there with the traditional active strategies which are out there, and that make us a tad bit different. Okay, and even for the investors who already have significant market exposure through AIFs, PMS, and mutual funds, we are a decent diversification for them.
Wonderful. I want to talk more about the mechanics, but we have to take a short break here. So please don't go away. Anshul and Karan are both with us, and we are talking everything Elever and wealth management. Stay tuned.
Forbes India and Elever present a Quant Leap in Investing. Forbes India and Elever present a Quant Leap in Investing.
Welcome back to Elever Presents, a Quant Leap in Investing in association with CNBC-TV18. Now, we have heard about Elever's vision. Now, let's dive into the mechanics. And Karan Agrawal here will break it down for us, how data-driven models and advanced technology are helping Elever deliver smarter, more sustainable investment outcomes. So, Karan, factor investing and quant models are gaining traction, that we know. Why do you feel this approach really works for your platform when we talk about sustainable alpha?
See, thing is that we believe that factor model through our testing over the last 20 years, but we have found out some winning factors that can generate a sustainable alpha in the Indian market. And if you look at the NSE research, NSE has also introduced some factor benchmarks. They're covering different factors like momentum, volatility, quality. Every single factor has beaten the benchmark by a good distance for 10 to 15 year holding period. Okay, but the problem, there's one problem with factor investing strategies, and that is your timing risk. Okay, timing risk is still there. So, for example, momentum is the most successful factor in Indian market. But had you invested in a momentum index, Nifty Momentum Index in 2007, for 7 years till 2014, your returns would be around 0%. Okay, while the benchmark same time gave around 30%, FD return around 60%, cost of living basically increased by 70% during that period. So basically, investors would have made it 0% over such a long period. And investors have right to question after such a long period that why the returns are zero, underwhelming returns are there, and they might, at the wrong time, they might take a switch to some other factor. Okay,
and it happened to so many of us.
Yes.
In absence of, I know so many people who made that mistake.
Yes, so factor timing risk is quite common. So to nullify that, we have introduced a tactical rotation model. Most of the factors have their own story. Okay, at some point there are certain times where some factors do well, like during the bearish phase, volatility, dividend, quality, these kind of low risk factors do pretty well. Okay, during the bullish phase, you see high risk factors like small cap, alpha, momentum, they usually do better. Okay, so what we have done, we have a tactical allocation model. In tactical allocation model, there are 5 parameters, input parameters: US VIX, India VIX, Nifty 50 line regression model, Nifty 50 PE multiples, and Government of India 10-year bond yield. Okay. Using these 5 input parameters, we get a signal that tells us whether it's going to be bullish phase, bearish phase, or market consolidation phase in medium to long term. Okay, medium to long term basically means 6 months or more. Okay, so based on these signals, we decide which factors are suitable at this point of time.
Karan, I have to ask you about AI and tech and how you are leveraging advantage of both with machine learning in your products and to make your products and offerings better. And what excites you about the new trends in AI and Gen AI spectrum?
See, thing is, we are already using machine learning extensively. We have tested the different factors on Indian market over the last 20 years. We have a tactical allocation model that is also using elements of, machine learning to some extent, a very limited AI. Thing is that if you look at the history of factor investing in US, okay, till 2000 dot-com bubble, growth factor worked pretty well. Okay, in next 5 years was pretty horrible in US market. Markets lost nearly 50% in dot-com bubble. That time value factor worked very well. Okay, from after great financial crisis of 2008. Okay, for 4 or 5 years, low vol factor worked very well. Okay. value largely disappeared. After ruling for 7 years, value largely disappeared for 13 years. All the value funds and everything that got closed down. Right. Okay, and then it reappeared in 2022. Okay, so we have built the models in 2022 primarily. Okay, so whatever conclusions we have regarding the factors and their alpha potential, we believe that they are going to stand for next 5-6 years. Okay, they are going. So changes are not like they're happening in 6-7 months. Okay, but there is a decent possibility that going forward, at some point of time, some of these factors who we have identified as winning factors today, okay, they may disappear. Okay, so alpha might disappear altogether. Okay, and some new factors which we have ignored till now, which we believe that not winning, okay, they might come into play. Okay, so we are basically looking at AI to enhance our models to incorporate these changes. Basically, decommission the factors which are going out of fashion and introducing new factors which are coming into play. Apart from that, the second aspect is tactical allocation model, because to give a 3 to 5 to give alpha to 3 to 5 year investor, it's quite important. Tactical model is accurate. Right now we have signals that are medium to long term. Okay, but apart from in these long term cycles also, there are some mini cycles. Okay, so what we are trying to do, we are trying to enhance this model by adding more parameters to take some accurate calls on those short cycles so that we can enhance the alpha further.
Thank you, Karan. Those were some great insights, and I really now understand not just the vision and mission, but also the working mechanics of Elever. Thank you so much.
Thanks, Mugdha. Pleasure meeting you.
With that, we are slipping into a very short break, but on the other side, we will continue our conversation with Anshul Sharan, so please don't go away.
Forbes India and Elever present a Quant Leap in Investing. Forbes India and Elever present a Quant Leap in Investing.
Welcome back to this very special conversation where we are tracing Elever's journey from its start. We spoke about how the vision came together, how the team came together, what are your products, why did you feel the need and felt the gap. Today, we are talking about customization, we're talking about hyper-customization.
Right.
Where do you see that piece fit in your story?
So see, for us, customization or personalization is not just a feature, but actually it's a core approach, how we provide our services to our customers. So we, as a belief, we believe that no two persons are same. Correct. Okay, so everyone has a different ambition. So what we do a step-by-step process. In a step one, we try to understand the customer, we try to understand what is the risk appetite, how much risk they can take. Second is we try to understand what are their preferences. For example, are they looking for income, growth, preservation, or a combination of all this? What kind of assets they are looking at? What assets fit to them? Third is we also look at their, their expectation in terms of what are their financial goals, what kind of returns they are expecting, those kind of things, right? So we try to understand the customer. The second part is based on this understanding, we build a portfolio for them. Right. Now, when we build a portfolio, we try to understand multiple things again. Like for example, when we talk to a customer, they may say that, I want 30% exposure to, mutual funds and the remaining can be equity, or someone may say 20% income I need, but the remaining can be growth, or someone can say, no, I just want 15% return, do whatever you want to do, right? So based on these kind of things, we build a portfolio. Third is, even when we do portfolio management, right, there also we keep on changing. For example, a person who has come to us at the age of 54, 55, he may be looking at growth right now with some capital preservation, but once he turns, retires, he may look for income also. So we change the portfolio accordingly that way also. So in a nutshell, personalization is our heart of what we do.
Wealth management as an industry is likely to change the way people invest in the country, how they view their money, how they want to grow it. Where do you see this industry in the next 3-4 years?
So see, if you look at the data, there is one significant shift happening in the whole industry. This is basically the two styles of investing, active style and passive style, right? Passive means index funds, ETFs, or even quantitative rule-based products which are there, right? So if you look at data in 2019, this was around 7 to 8% of the AUM was over there.
Right.
But if you look at 2024, this is almost 17%. So there is a significant shift happening from that. And this shift is nothing new for India. I think if you look at developed markets like US, Korea, Australia, Europe and all, they have shifted from less than 2% to now more than 65-70%. Right? This shift is something which India will also go through. If you look at the other data points, your passive funds have grown from a $2 trillion AUM to $11 trillion with a CAGR of 41%. Compare with active funds, which has grown only by 21% CAGR.
Yeah.
And even the new age AMC which are coming like Grow, Navi, Zerodha, all of these guys, they're all launching passive funds. So there's a significant shift. And if you look at our journey, we have been a passive shop from day one. When I say passive, we have been quantitative, rule-based, innovative product what we've launched. And that's where we want to be focusing on. We want to be the go-to destination for any of those kind of quant-based passive products.
I do see investment for all as one of the guiding principles for you as well. What are some of the trends that are exciting you about the overall industry and what is likely your growth story going to look like in the next 4-5 years?
So I think I'll break it down to two goals. So we have medium-term goals and long-term goals. For next 3 years, what are we planning? And then what we are doing in 5 to 7 years.
Yeah.
Okay. So definitely the PMS will be our core engine. Okay. And supported by our advisory models.
Right.
And we want to spread across the length and breadth of India. This, we want to target the emerging HNIs in the tier 1, tier 2 towns.
Correct.
So that will be our main thing. But the other thing which we are going to focus on next 3 years is launch passive AIFs also for the global and Indian institutions in the near future, and also launch PMS or AIFs in Dubai and Gift City. That's our plan. Because that will help in catering to not only Indian market but global markets for the Indian and global investors using our innovative way of how we are doing the products, right? So in a nutshell, in the next 3 to 4 years, we want to hit around 4,000 crore AUM. That's our plan. And this will help us create a global brand for us and also build trust. So that's our medium-term goal. Now, if you look at a long-term goal, and if you remember the vision, what we have, investing for all. So the idea is that we want to launch our own mutual funds, 6-7 years down the line, and that will actually envision investing for all. Right? Here also there are two things. One is that we want to do mutual funds once we reach close to 10,000 crores. Because then by then we'll have a global brand, we'll have a track record, 6-7 years of track record, we'll have that traction also. So it will be easy for us to sell, we'll have our own network which are built. That is one. Second is the mutual fund what we'll launch will also be unique in the sense that it will be technically an active fund as per SEBI norm, but it will be at the cost of a passive fund like index fund because we are managing our product passively. Right? So our costs are not going to be high. So we can offer that at 0.1, 10 bps, 15 bps, which is what generally passive funds are. So compared to active funds, we're much cheaper. So from a investor perspective, you are getting consistent alpha because of our methodology, superior returns, at the same time lower cost. Right? So it's basically a double booster for any investor's wealth creation perspective. So that's what we are aiming for. And beyond that, sky is the limit. Let's see.
Well, thank you, Anshul. Thank you so much for your time. And I wish you all the very best with your vision because it actually empowers millions who have the ambition of growing their money and making wealth advisory available to all. So thank you so much.
Thanks a lot. Thanks a lot.
This was wonderful.
Thank you.
Forbes India and Elever present a Quant Leap in Investing.